You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have ITV, ASOS, Boohoo, Airtel Africa, Adidas, and the US company of the week is Disney. Sam, do you want to kick us off with ITV?
Yes. So ITV have come out with their first quarter results and they reported a first quarter net revenue decline of 7% to 776 million. The drop was mainly due to lower advertising revenue, which fell 10%, though that was better than the broader market. Revenue from ITV Studios was flat at 457 million, including a benefit from exchange rate moves. ITVX continues to do well, with digital revenues up 29% and total streaming hours up 49%. Net debt in the period was up from 623 million to 668 million. The outlook for advertising revenue remains challenging, with a 12% drop expected for the second quarter. With that, digital advertising revenue is expected to rise over 20%. ITV Studios is forecast to deliver an underlying cash profit margin towards the lower end of the 13 to 15% medium-term target range, with mid-single-digit revenue growth. Carolyn McCall, the CEO, discussed ITVX, and she said, ITVX has sustained its strong launch with a 49% increase in streaming hours and a 29% increase in digital revenue in the quarter. Exclusives such as Nolly and The 12 attracted new viewers, 80% of whom went on to explore other content on ITV. And if we break the results down a bit more, for the ITV Studios segment, total revenue, including the benefit of foreign exchange, was flat at 457 million, with the phasing of deliveries in 2023 expected to be weighted to the second half. ITV Studios delivered a wide range of new and returning programmes and formats in the UK and internationally as it continues to diversify by genre, geography and customer. And deliveries in the UK and internationally included Nolly for ITVX, Django for Sky, Big Beasts for Apple TV Plus, and Queer Eye for Netflix. The media and entertainment segment revenue was down 9% to 495 million, with total advertising revenue, as expected, down 10%, better than the wider TV advertising market. Within this, digital advertising revenue was up 30% at 87 million compared to the same period in 2022. In terms of the valuation, business shows a forward P of 8.4, and that compares to a 10-year average of 11, and the prospective yield over the next 12 months is 6.4%. I thought these results were okay. For me, what makes them okay is, yes, there's a decline, but if the advertising market does fall, there's very little they can do about it, and their revenue has fallen less than the wider market. And on top of that, there's a few parts of the business, like, for example, ITV Studios, that do seem quite interesting, like the fact that they're making content for other businesses like Netflix and Apple. I think that's quite interesting. And it is very cheap, and the dividend yield is very high. I probably wouldn't buy it just because I don't feel like it's an outstanding business. Not that every business in my portfolio is an outstanding business, but ideally they would be. But I just think it's quite an average business that's doing quite well with what it's got, and it's pretty cheap. But for me, I don't really want to buy something on that basis. And if I bought it, I feel like I would have to constantly keep an eye on it as well, just because of the nature of the market it's in and its position in it. John, what are your thoughts on these results and the valuation?
Not terrible, but it is disappointing to see net revenue down 7%. I think when you talk about the advertising revenue, it is a cyclical company, and I think it is lower quality as well. Probably, you could argue that that's just reflected in the valuation. But the last company that we're going to come on to in terms of content protection, much better. So ITV wouldn't really be one that I'd look at any further. I think there are lots of better options out there, and I wouldn't really see myself as sort of that value investor that might look, for some, I suppose, diamonds in the rough with ITV.
Yeah, I think that's my issue with it as well. It's you'd be buying it. It's not a business I want to own, if that makes sense. Like, whereas like with the business will be covering last. Disney. I want to own Disney. I like Disney. I love the brands. I don't think ITV has any brands that I would say I love. And its main attraction is that it's very cheap.
Yeah.
And I don't really like cyclicals either. Although I do think management seem to be doing a decent job of it.
Yeah. Okay. On to, I don't know whether you call it a quality company, Sam. Hasn't been doing too well recently. ASOS, the online fashion retailer, once a darling of the alternative investment market, had their half-year results out last week, with first half revenue down 7% to £1.8 billion, excluding the impact of exchange rates and suspended trading in Russia. The group say that this reflects a challenging trading environment, as well as reduced marketing activity and a lower amount of markdowns on prices. Sales were down in both its key markets of the UK and the US, and underlying operating profit fell from £26.2 million to a loss of £69.4 million, with the lower sales combined with higher costs. Wage inflation in the group's distribution centres has been especially high. Net debt worsened from £62.6 million to £431.7 million as a result of the higher borrowing and lower cash levels. Free cash outflow worsened from £256.5 million to £262.7 million. Going forward, the group expects full-year sales to decline by low double-digit percentage, and underlying operating profit is expected to land in the region of between 40 and £60 million range. In terms of valuation, ASOS has a market cap of just under £400 million, doesn't have any earnings, and its share price has fallen by nearly 40% since these results were released last week. Clearly having a very tough time, and it's concerning to see its top line being hit with cuts to the marketing and the reduced discounting in what is overall a more value-orientated proposition. In terms of the long-term strategy, again, I think it's concerning to see the group reallocating resources away from the US, but clearly it's difficult as it needs to focus on improving profitability again. But as a long-term strategy, I suppose it's more worrying. And where does it go? I wouldn't be buying shares at the moment. I'm holding Boohoo, which we'll come on to later, and it's not dissimilar. But yeah, I think it's going to be a very choppy period, and who knows where it'll end. If it does get to that underlying operating profit between 40 and 60 million pounds, I think that would be very good news indeed. Sam, what are your thoughts?
Not impressive. Like you say, it's if they're pulling resources away from the US, because we've covered this for a couple of years now, and we've sort of said, well, yeah, they're pretty saturated in the UK, but look at what they're doing in the US. If they can keep growing there, they'll be fine, and that's not happening. I think the net debt's concerning, especially with the cash position. So net debt, 431 million, and 262 million of cash went out the door in the half. That's bad. I think it's cash-wise, it's in a worse position than Boohoo, which we're going to cover next. They have been doing cost-cutting, and they are expected to get back to profitability in the second half, so at least they can then tread water. But yeah, it's not in a fantastic position. I think if they can get back to profits, it's all right, but the debt's concerning. I think last time we covered it, it seemed like the results were a bit better than Boohoo's the last couple of quarters, and I think we've had a couple of discussions where it's, well, did we buy the wrong one? I'm not sure either of these businesses was the right one to buy. But I'm not sat here like the last couple of times thinking, oh, why didn't we buy ASOS instead of Boohoo? I mean, they're both pretty ugly. So, yes, it's not good.
Do you want to just lead into Boohoo now, Sam?
Well, yeah, continuation of the same.
Put the listeners out of their misery.
I might just copy and paste what you've said when I'm editing, just dub over ASOS with Boohoo. But yeah, Boohoo have also come out with results this week. So they've come out with their full year results, and full year revenue fell 13% to 1.8 billion. Comparison, that compares to 7% for ASOS, but they had Oh no, that's ASOS is twice as big, isn't it? Because that's half year. Ignoring the effect of exchange rates, UK and international revenues declined 9% and 13% respectively, with lower consumer demand being blamed on cost of living pressures and extended delivery times. Underlying operating profit fell 92% to 6.9 million, impacted by the fall in sales, as well as freight, labour and energy cost inflation. Free cash flow improved to an inflow of 30.2 million from an outflow of 251.2 million last year due to inventory and working capital improvements. Net cash improved slightly from 1.3 to 5.9 million. This year, revenues are expected to be anywhere between flat and a decline of 5%, so not as bad as the year ASOS are predicting revenue-wise. Underlying cash profit is expecting to land between 69 and 78 million with a margin of 4 to 4.5%, and the shares were up 13.8% following the announcement today. Revenues declined across all regions, most notably down by double digits in the USA, which had been seen as the major growth driver going forward, so that's concerning. Active customer numbers fell by 10%. Well, you would expect some normalising still from the big boost they had in the pandemic. And then supply chain costs are now starting to get better. Freight costs are falling and inflation's easing. However, these are all still issues, not as bad as they were 6 months ago. The main concern with Boohoo is if they do not get back to growth, they have invested a lot in increasing their capacity. So as an example, their US distribution network becomes fully operational in 2024. And at the minute, US revenue is falling. So as it stands, they do not need that extra distribution. So you are relying on management being right in terms of this just being a blip and they're going to get back to growth. If it is just a blip and they do get back to growth, I think it's pretty cheap. Because the profits have fallen that much, the PE's now become useless. But a forward price of sales of 0.27, and that compares to a 10-year average of 2.18. No prospective dividend. The general gist is it's very cheap. In terms of the share price, part of the reason I think the shares are up on this news is, firstly, the results aren't as bad as ASOS is. The guidance is better. But in the last month, it's already pulled back 25%. In the last year, it's down 53%. Which is probably about when we got it, maybe even earlier. We thought it was cheap then. And in 3 years, it's down 89%. I think I first bought it at about £1.20. It's at 41p now. But I did average down to bring my average cost down. So my average cost is probably somewhere around, I think, 80 or 90p now. So it's now at 41, so I'm down significantly. I will not be adding any more. In terms of my thoughts, I think the results are better than ASOS's. I think hopefully this is just a blip. The fact that ASOS is down too sort of suggests it might be, because it's not like you've just got one business performing poorly in an industry that's doing all right. If they can get back to growth, I think it's very, very cheap. I think their decision to invest in more capacity will start to look like a smart one. If they don't get back to growth, I think at least their cash position is not as bad as ASOS currently is. But that being said, I'm still not thrilled about owning it. But I will be holding on to it. But I certainly won't be adding any more. John, what are your thoughts on these results and the valuation?
I mean, very similar to what I said about ASOS. I would probably be more optimistic about the future. And I know various biases are involved here, but they are positions in the US strategically, again, better than ASOS. So I think that is a positive for Boohoo if you have that outlook about it. And also perhaps in the meantime, that it is more value focused than ASOS. So I think that's possibly a positive too, certainly in the near term. But it's not easy holding the shares, that's for sure. I, again, won't be adding to them.
No. Have you added to them?
I've, like you, I have averaged down once. I haven't added to them in months, though.
Anyway, should we move on to a business that we're happier to own?
Yes. So Airtel Africa, the favourite African telecom of the show, had their full year results. Tough competition there. Yeah, they had their full year results out last week, with revenue in constant currency up 17.6% and up 11.5% to $5.2 billion in reported currency. Underlying EBITDA increased by 17.3% in constant currency and 11.4% in reported currency to $2.5 billion, with an underlying EBITDA margin of 49%. Profit after tax was $750 million, a decrease of only $5 million after including a higher foreign exchange and derivative losses of $245 million. The total customer base grew by 9% to 140 million, and penetration of mobile data and mobile money services continued to rise, driving a 16.9% increase in data customers to 54.6 million and 20.4% increase in mobile money customers to 31.5 million. Constant currency average revenue per user growth was 7.4% and largely driven by increased usage across voice, data and mobile money. Mobile money transaction value increased by 41.3%, with Q4 23 annualized transaction value exceeding $102 billion in constant currency. In terms of capital expenditure, CapEx increased by 14% to $748 million, in line with guidance as the group continued to invest for future growth. Additionally, the group acquired spectrum in Nigeria, the DRC, Tanzania, Zambia, and Kenya during the year. In July 2022, the group prepaid $450 million of outstanding external debt at the parent company. The remaining debt at the parent company is now $550 million, falling due in May 2024. Cash at the holding companies was now $398 million. Leverage is at 1.4 times in March 2023, broadly stable despite $500 million of spectrum investment during the year. The board has recommended a final dividend of 3.27 cents per share, making the total dividend for full year 23 at 5.45 cents per share, which is an increase of 9% in line with their progressive dividend policy. In terms of valuation, Airtel Africa has a market cap of £4.4 billion and trades at around 8 times earnings, with a prospective dividend yield of nearly 4%. Again, I thought these results were very good, particularly with the inflationary environment there in the background. They've continued to grow, and particularly that data and the mobile money leading the way. I think it's cheap at 8 times earnings, but it's not a company without its risks, particularly, currency being one of them, but also the political risks in the nations that it operates in. I'm a shareholder, very happy to be one, and it's a long-term view with that company. I think there's lots of growth in the mobile money and in the data too. And when you see some of the stats about the number of people in Africa or Africans who have bank accounts, it's growing so rapidly in the mobile sector rather than those traditional bricks and mortar, and still huge percentage or proportion of the population that aren't banked. So massive growth, I would see ahead of it, but like I say, not without the risks. Sam, what are your thoughts on the latest numbers from Airtel Africa?
Very happy with them in terms of the obvious. Well, yeah, in terms of the numbers they're putting up, there's not really much to complain about. Constant currency revenue growth of 17%. I know they've lost some on the exchange difference, so it drops to 11%. Still pretty good. And the mobile money is what I always focus in on. And so the revenue growth is 29.6%, but the transaction value is up 41.3%. And the annualized transaction value now is over $100 billion a year. I remember when we first started looking at this, it was something like in the previous year, they'd done 50 billion. And that was just, I thought that was very impressive. If they carry on growing at similar rates, in a couple of years, they're going to be adding more than 50 billion in a year to the transaction value. I know it's going to slow down as they get bigger, but in the next couple of years, they're going to be spinning out that as a separate business. So it'd be interesting to see what that trades for. It's not like they're going to be able to saddle it with loads of debt or anything either. It should just be a quality business, because even apart from the fact that the main business can be quite capital intensive, I think the main concern with this when we first started looking was the debt. It was much better than it had been originally, but it was continuing to move in a good direction. And I think to keep leverage at 1.4x, I'm pretty happy with it. I don't really have an issue. It's not at a level I'd consider concerning. A lot of the debt's the parent company, so they're not going to be sending the debt collectors around straight away. And then I think this well positioned for growth. You've got the mobile money business coming out in a couple of years. And then on top of that, you get nearly a 4% dividend, and it's at 8 times earnings. I really like it. It's one of my favorite positions. It has pulled back a bit recently. I say recently, in the last year or so. What's it down? It's down 15% in a year. However, since I think we first started covering it at about 80p a share, something like that. So I'm still up pretty nicely on it at 116p. But since we started covering it, the business has grown a lot, and the earnings hasn't really changed. I think it was about 8, somewhere between 7 and 9 when we first started. The business has gotten bigger, and it's still somewhere between 7 and 9. There's not really been any multiple increase with this. It continues to be incredibly cheap. There are risks associated with it, especially in some of the countries it operates, especially with some of the exchange rates it's dealing with. But there's a lot of opportunities, and I do really, really like it. I hold it. It's one of my biggest holdings. I recently added to it about a month ago. Yeah, I really like it. One thing I'll add as well, so I did get a message from Pat, who is at PatCat68 on Twitter. So he's one. Do you remember Pat, who went to the Fundsmith meeting?
Oh, yeah.
Yeah, the mega lad, Pat. But he messaged about a week ago saying that he'd listened to the latest Business Breakdowns podcast about MTN Group, which is the largest mobile comms and money FX operator in Africa. So there should be, I've not listened to it yet because I'm currently trying to get through a 38-hour audiobook on Napoleon. However, afterwards I do intend to do that. But so if you're wanting to learn a bit more about the business, about the market in Africa, it's a 1-hour podcast on MTN Group, which is one of the competitors, and talking about the landscape in Africa. It's called Business Breakdowns, episode 109, if anyone does want to go and find it. And hopefully by the next time we cover Airtel Africa, I will have then listened to it. So yeah, bit of a monologue there, but that's what I think.
Very good. On to another company you like, Sam, Adidas.
Yes. So, Adidas, again, I'm sure it needs no introduction. We have covered it before. Have you seen Air, by the way, John?
Not yet. I was planning to see it at the cinema. I don't know whether I'm going to have to get it on streaming now.
It's on. I think it's still in the cinema, but you can now see it on the Amazon adverts as well, can't you? If you've got a Fire Stick, it's coming to Amazon soon.
Oh, very good.
But it is very.
That's a rival, isn't it?
That's what. Yeah, it is. Yeah, but it's very, very good. Anyway, Adidas have come out with their Q1 results. All these figures will be in euros, but the company's revenues declined 1% to 5.274 billion in the first quarter. If we break this down, wholesale revenue grew 3%, driven by strong growth in Europe, Middle East and Africa, Asia Pacific and Latin America. Direct consumer revenue declined 7% versus the previous year. And this development reflects the adverse Yeezy impact on the company's e-commerce business, which was down 23%, as the vast majority of this product used to be sold through Adidas' own online channel. At the same time, sales in the company's own retail stores increased 11% in Q1. We'll be talking about Yeezy quite a bit, actually, because it's mentioned quite a lot in this report. They've said that currency-neutral sales in North America declined 20% during the quarter, as the region is particularly affected by the discontinuation of the Yeezy business. In addition, significantly reduced sell-in to the wholesale channel as a result of high inventory levels in the market weighed on the top-line development. While total revenues in Greater China declined 9%, the sell-out of the company's products increased year over year, as reflected in double-digit growth across Adidas-owned retail stores. Sales in Europe, Middle East and Africa grew 4%, driven by high single-digit growth in wholesale. Revenues in Asia Pacific and Latin America both continued to increase at double-digit rates, with Asia Pacific up 16% and Latin America up 49%, driven by growth in both wholesale and direct consumer. The company's first quarter gross margin was down 5.1% to 44.8%. The decrease was mainly driven by the increase in supply chain costs, as well as higher discounting in the marketplace. In addition, inventory allowances, the adverse Yeezy impact, and the negative currency developments weighed on the gross margin development. Operating profit was 60 million, which resulted in an operating profit margin of 1.1%. and that fed through into a net loss from continuing operations of 24 million. For the full year 2023 guidance, Adidas continues to expect currency-neutral revenues to decline at a high single-digit rate as macroeconomic challenges and geopolitical tensions persist. Company's revenue development will also be impacted by the initiatives to significantly reduce high inventory levels. In addition, while the company continues to review further operations for the utilisation of its Yeezy inventory, guidance reflects a revenue loss of around 1.2 billion from potentially not selling the existing stock, accounting for the corresponding negative operating profit impact of around 500 million. Company's underlying operating profit is projected to be around the break-even level in 2023. They project a reported operating loss of 700 million, and they've said should the company irrevocably decide not to repurpose any of the existing Yeezy products going forward, this would result in the potential write-off of the existing Yeezy inventory and would lower the company's operating profit by an additional 500 million this year. In addition, Adidas expects one-off costs of up to 200 million in 2023. I think I saw something the other day where the plan with the Yeezy now is I think they are going to sell it, but the profits are going to go to like Jewish charities and stuff. In terms of the valuation, the business trades at a P ratio of 128, which is not particularly useful. Market cap's about 30 billion euros, and that compares to about $200 billion for Nike. So this is a fraction of the size of Nike. The price of the business is actually up 60% from the low it set in October. However, it's still down about 50% from its high. But I just think it's quite expensive. So if you take the earnings for the 4 years prior to this year and just take the average, and then look at it on a 4-year average PE basis, excluding the most recent year, you still get 24, which I think, considering the issues it's got, the fact that every time we compare these results, they're not as good as Nike's, it's got the whole Yeezy issue. Even if it can bring out a similar kind of shoe, it's not going to do as well as Yeezy. It's not going to have the exclusivity. Maybe they'll go out and get some other pop star or someone, but it's a difficult thing to do. I just think 24 times last 4 years of earnings as an average, I think that's actually quite expensive, especially when Nike's executing so well. And I know Nike's a lot more expensive, but I kind of want to see this trading at a bit more of a discount. That being said, it is obviously a fantastic brand. I don't think any of these problems are anything other than temporary. I think the size of it compared to Nike is a huge opportunity, but it's an opportunity that could take years or even decades for someone to fully exploit. I'm not really concerned about the direct-to-consumer drop because that is, I think, a one-off as a result of Yeezy. And I think in the long term, more and more of the sales will be direct-to-consumer. I've started using direct-to-consumer for Adidas myself quite a bit in the last quarter, and it probably has made me more engaged as a result. I think I am like looking to buy more shoes than I normally do. Just because if you go in and there's like a shoe that you like and it's like 30% off, I do tend to, I can get quite tempted. So it's a fantastic business. It is a business that I would definitely like to own, but I would need to see it considerably cheaper before I considered pulling the trigger. John, what are your thoughts on the results and the valuation?
Yeah, I'd probably agree with you that it's on the expensive side for the numbers that it's putting up and some of the problems that it has. It'd probably go on my watch list, but not one that I'd be pulling the trigger on at the moment. I was going to ask, Sam, you mentioned the film Air. Did that inform any of your research at all or your thinking about Adidas?
Not really. It was really interesting. It's a really good film. It'd probably be more informative in terms of like looking at Nike, especially because without in fact, it doesn't spoil it at all. But in Air, the three main shoes are Nike, Adidas, and Converse. And now, obviously, Nike's the biggest by far, and it owns Converse. And I think it's good at highlighting how Adidas has almost sort of fallen by the wayside. Because in terms of marketing and stuff and branding, I don't think there's much difference between Nike and Adidas. I think they're both incredibly powerful brands. But then when you look at the size of the businesses, Nike's over 5 times bigger. And I just don't think you expect that given how popular the Adidas brand is. And I just sort of look at it and think, well, what are they doing wrong? I think the answer is quite a bit. But that being said, they are up against a competitor, which is just I mean, that Nike's just one of the best businesses on the planet. It's just fantastic. But I think it does highlight that there is a lot of opportunity for them.
Very good. Well, on to our last company of the week, which is certainly a favourite of the show, is Disney. They had their second quarter results out last week, with second quarter revenue up 13% to $21.8 billion. Despite the higher revenue, though, operating profit fell 11%, with a 35% drop in the group's linear TV networks. This was partly caused by higher sports programming and production costs in college football playoffs and the NFL at ESPN, together with lower advertising revenue. Losses narrowed in the streaming business as they fell to $659 million compared with a $1.1 billion loss in the prior quarter. This was driven by higher prices and a reduction in marketing spend. The service actually lost around 4 million subscribers, largely in India because of the loss of some popular cricket rights. There's also losses in the Western markets, and analysts had expected Disney to actually add 1 million subscribers. On a more positive note, the rebound continued in the parks divisions and the experiences business. Growth at the Shanghai Disney resorts, Disneyland Paris and Hong Kong saw operating profit rise 23% on last year to $2.2 billion. The best performance at the parks helped free cash flow more than double to $2 billion, while net debt was $38.1 billion. In terms of valuation, Disney has a market cap of $182 billion and trades at 21 times forward earnings, compared with a 10-year average of 23, and has a prospective dividend yield of 0.8%. It was disappointing to see the operating profit fall 11%, but it was in a part of the business that I don't see the group being dependent on for future growth. That being said, one of the parts of the business that they are dependent on for future growth, Disney Plus, did drop subscribers in what is becoming an increasingly competitive market. Although very good to see the parks themselves doing well. I think Bob Iger has got the right strategy, and in the long term, that'll win out for Disney, and it will be a big player in a growth market of streaming with its award-winning IP. So while a little bit bumpy at the moment, I'm quite happy holding the Disney shares. Would consider adding to them. It's not one of my biggest positions, but it has been added to over the last 18 months, and I consider doing so again. Sam, what are your thoughts on the latest figures from Disney?
I think they're all right. The loss of Disney Plus subscribers is disappointing, but the majority of them are in emerging markets, and they're just nowhere near as valuable as the Western ones. I know they've lost Western ones too, and that's probably more disappointing. The Indian ones, it's not real. I mean, some of them are paying something like 60 cents a month or something ridiculously low. They're not, and I know some of what they're adding is just pure profit, but they're not the most valuable subscribers. That's just the reality. But in the last few years, we've put up with these losses in the streaming business, and my view's always been, well, that's fine. Get as many subscribers as you can, get as many subscribers, keep growing, and then start pushing up the prices when you've got that quality content that everyone's just dependent on. I still think they can do that. Netflix is more saturated in this market, but we've covered Netflix multiple times on the show. In the last year, 18 months, they've had a bit of a wobble, and now they've got back to growth. So this will happen. It's not going to grow every quarter forever in terms of subscribers. It will ebb and flow. But I think in the long term, I think it's still going to carry on going up. I do think the strategy that Bob Iger's bringing in is the right one. I don't think it needs to be losing as much money on content as it is. But, if it's if a loss now of 659 million, it's not that much, especially for Disney. It can afford that in perpetuity, and you want it to get to operating profit. But as a long-term scenario, they might be in a position where they're comfortable losing money on it because it's doing so well in terms of bringing people into the ecosystem, and it's pushing the parks and the films and the merchandise that actually, they could still run it at a loss and actually do very well, whereas none of its competitors can do that. And that's a massive difference for Disney. and it shows the quality of the IP. I don't think they will run it at loss forever. I think eventually this would be where I would hope the majority of the profits come from, or at least a decent amount. I think the brands they've got are just such high quality. I don't think it's cheap, but it's more reasonably priced. So forward P of 20.7, it's not cheap, but it's one of the best businesses in the world with some of the best IP. So it's how cheap are you going to see it? I do own it. I don't think I've added to it as aggressively as you have, John, in the last 12, 18 months. I wouldn't. It's certainly something that I've been considering adding to recently. It's just, there's at the minute, the issue I've got is I'd want to add to PayPal before I add to this, but absolutely not against adding to Disney at the minute. And if I'm sat here in 12 months' time and it's stayed at these prices, I'd be surprised if I haven't added to it. But yeah, fantastic business. I do think this is just a wobble, especially with Bob Iger running the show again. In the long term, I've not really got that many concerns with this business. I think they will be fine. That's one of the things. That's partly why I think you won't see the valuation drop too much, because they've just got so many levers they can pull, and they've got so many different parts of the business that are contributing that, you know, they can afford. You know, it would be disappointing, but they could just get rid of the streaming business overnight. It's still a good business. That's what I like about it. Whereas you take away Netflix's streaming business overnight and there's nothing left. And all the businesses parts of the business make each other stronger. And I think if you're willing to give it a bit of time, I think this is just a fantastic long-term business.
Of the companies this week then, Sam, which one would it be?
I'd probably go with Airtel Africa. I think it's, if we're asking which is the best business, for me, it's Disney. Although maybe you could make an argument for Adidas. But I think in terms of the figures it's putting up, the opportunity, the market it operates in, the money side of the business being spun out, the valuation as well. For me, Airtel Africa is a no-brainer. What about you?
I would also go for Airtel Africa, and I think the potential for growth is just massive. If it were to be the only stock in my portfolio out of that bunch, it would definitely be Disney, though.
Yeah, you'd feel more nervous with Airtel.
Yeah,
but I suppose
absolutely.
the bonus is, as long as it doesn't go bust in the next few years, you'll have two stocks. Because it'll split out Airtel money. So
yeah, make up for if Boohoo's still around.
Well, yeah. So what have we got? Oh, so we both own half the stocks this week. It's the same half.
Yeah, and I think there's, the last on the list that would probably be the same too. Of the ones we own or that we look at topping up, that would definitely be Boohoo at the back of that pile.
Yeah. I've already topped up Airtel Africa, and it's probably at a size again now where I wouldn't top it up anymore. But that's just because it's quite a big chunk of my portfolio again. Well, it was already a big chunk when I topped it up. Whereas Disney, it is a smaller allocation, so I wouldn't mind taking Disney a lot higher.
No, great. Well, thank you again for listening, and see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.